Yes,
Oh,
just fine.
fantastic. So, how has it been?
Fine. Thank you, Paul. Everything's been fine.
Oh, that's fantastic. So, how is the US of A?
Everything is fine. I can't complain.
So, how is the general economic outlook?
You said again?
The general economic outlook in the US?
How's the outlook in the US?
Yes.
Look, everything's fine. I cannot complain. Everything for me is going pretty well. I am excited. Yes, on yesterday I got some of the best news ever. I've been waiting for my top secret security clearance to clear, so that I can go back into the industry of engineering as a government contractor. And yesterday I got the call from my supervisor that my tier 5 security clearance has completed. So soon and very soon I will be moving back to Maryland to work as a government contractor. So I'm excited. The girls and I are very excited about that new form of income.
Yeah, so that's very nice. That's very
Yeah.
nice. So how does it work?
Yeah, so I'm in the industry. I will be tasking satellites. So I'll be actually looking at imagery, and I'll be like the liaison between the contractor world and the government world.
Oh, that's nice.
Mm-hmm.
Okay. So that's a very good news.
Yes, it was.
Okay. All right. So let's go right into it. I will just share just a minute. So again, today by the schedule is clear as to what we're looking at today, right?
Yes.
Okay, you got the schedule. Good. So I'll just try and share my screen. Once you can see, let me know.
Yes, I see.
Okay. So today we'll be looking at risk management and trade management, right? So looks like a Siamese twins because risk management, trade management, they are interrelated, right? So it all forms the overall, how the risk profile is and how do you also dilute your risk, right? So this topic, it's very important for all traders, you and I. It is very important that risk is everywhere, right? There's virtually no endeavor that will not have a form of risk. Is that correct?
Yes.
So practically every good thing also comes with its own risk. So for example, even though it's a good thing, just the way you just spoke about your daughters, right? So even though it's a good thing for a mother to give birth to a child, but going through that journey, right, of pregnancy, there's also the risk. Some persons are unfortunately involved in miscarriages, right? So not everybody then gets to the final point of giving birth to a child. So there's element of risk in everything that we do.
Right.
So for example, even when you have your money, you put it in a bank. There's a risk there in that, again, not that it depends on the kind of bank you have put your money. If it's a bank that is well regulated, of course, there is insurance. In the event that the bank goes down, you know that your deposit is protected, right? So the risk in that is that, okay, you put money in a bank. Again, the value of money could depreciate, correct? Because of inflation, right? So
Yes.
because you drop money in the bank and what maybe something you can buy now, let's say $100. And, you know, they keep the $100 in the bank. In the next 2 years, you want to buy that same thing. And the seller tells you, oh, this thing is now $150. And if you check the appreciation of your money, let's say it's $110, it means that inflation has taken about $40 from you, right? So there's that risk. And in that context, it comes to us in form of inflation. And that's depreciation in the base currency. So likewise, trading has its own risk.
Yes.
Why that is so is that we don't have control over what the market will do. You know, we are just simulating, we're just predicting, we're just hoping, right? And, you know, because of a pattern that we have seen in the past, we're able to say that if this XYZ happens now, this is the likely direction of the market. So it's a probability, right? Because we don't know for sure what the market would do. And that's why we as traders, we are very flexible, right? We're very flexible in terms of our thinking. So we don't take very rigid position. It's a probability, it's either a yes or a no, and it can go in your favor or go against you. So the discussion now is, when it goes against you, you know, how deeply can it go? How far down can it go against you? And that's where the risk management comes in, because we're not so sure what the market would do. So if we're so sure of what the market would do, we will not be trading with the stop loss. Is that correct?
That's correct.
So because if we are very sure that perhaps US 30 is going to buy, let's say, to 35,000, for example, it means that we just enter a trade and will not put a stop loss, because we know that from our entry is going to give us our take profit that will make huge amount of money. But because we know that that is our own thinking, that is our perspective, the market can do its own bidding, can decide to go in our favor or go against us. And that's why risk management is also very important. The second reason why risk management is something that we need to pay keen attention to is because trading is a continuous process, right? It's not a one-off activity. And, you know, you want to be able to trade today and also have the capital to trade tomorrow. Because some days could be bad and some days could be yo-yo for us. So we don't want to lose ourselves or lose our money when we're having a bad day, right? So that the day that we then be having a very fantastic day, we don't have capital to trade. So we don't want to be in that situation. And that's why we need to manage our risk and also protect our capital so that we also live to trade another time, right? That is just the logic. So our ability to say, you know what, once I take this loss, well, I'm done trading. I know that I can go to the market and recover the money, but I don't even want to recover it. I'm done. Let me rest my mind. Let me come to the market with a revitalized mindset, right? A well-rested person. And let me look at my chart again with a clearer view, because at this point, I'm not under pressure. It's a new beginning, right? So it's different from when you check your MT4, you're already at minus 1,000, minus 500. The thinking at that point will be so biased, right? It will not be balanced anymore, right? And again, the human person will be very impatient. At that point, you can't control yourself, right? You can't control yourself until the worst happens. Then one will then take a breather. But risk management is just to help us. Those kind of situations will be there, right? And if we don't take risks, there's no way we'll make money. So it has to be a balance. We can't say, oh, I don't want to take risk. I'm risk averse. if you are not willing to take risks, you'll not also be able to make money. But what is then important is that we're able to take calculated risk. And that will be based on informed position and based on our understanding of, the trading ecosystem. All right, so we just go straight into it and see what we can learn from this.
Okay.
All right. So basically on the introductory part, we just, again, the foreign exchange market is very interesting, right? We're all in the market to do two things. It's either we are buying or we are selling. So, and that's why it's a marketplace. So typically when you go to a market, except you are a bystander, you would either be in the market to buy or you are in the market to sell, right? So if one is not able to fit himself into either of these buckets, it means that the person does not have any business within the market arena, right? So, and in buying and in selling, of course, there will be inherent risk. Even when you look at what we do aside trading, when you go to the market and you buy a commodity, so even though the seller will tell you that this is original, right? This is a customized t-shirt. It's actually from TM. It's the original one, you can go home and somebody who knows it better would say, no, this is imitation, right? This is not the original. But you would have paid original money, So it happens. So likewise in our trading, you can see, a trading pattern like a confirmation. It gives you an indication. So you can liken that to the person who is telling you that this is Versace, right? This is the original one. And, this Louis Vuitton, just buy it. It's, it's unique. So you can see a candle giving you that kind of signal, telling you, oh, it's time to buy, right? So if we don't look at it very well, we'll jump into a buy, whereas it's a wrong insight that candle had given us. Perhaps the market is looking for a sell, right? So those kind of situations happen in the foreign exchange market. And that's why we need to protect ourselves, right? Because we understand that these things would happen. And therefore, we also need to be prepared such that when it happens, it doesn't give us a very massive loss or put us in a depressing position, right? So again, so why we're taking time to just look at this, to have this conversation is that because we want to be consistent in our trading life, in our career as traders, whether a part-time trader or a full-time trader. It means that risk management, we need to view it as something that is very important, right? Because it summarizes whether we will be successful or would struggle. I wouldn't want to say whether we'll fail. We may struggle. Then at some point, when we're not able to meet up to that struggle, we can then drop off, right? But if we are able to, take full control of this and, coming to that realization that the FS market is a very risky market. Why is it risky? Because we don't have control over most of the things that would happen. However, those elements that are within our circle of influence, we need to be able to master those so that once the market gives us the unexpected, it's something that we are expecting already. So we're not surprised, right? And that's why risk management is also very important. So risk management is very, it's very crucial for us as traders, right? So our ability to manage risk is basically the foundation. If we want to succeed in our trading career, if we want to make money and we don't want to bring from our savings, invest into trading, and we are not making any return, over time, frustration will come in, and we'll then leave it and say, trading is very risky. Of course, it's very risky. But the human person, again, is also a risky entity, right? So even though trading is risky, if we ourselves we're also risky, it means that there'll be explosion, right? So we understand that trading is risky. We'll then come with, because we are supposed to have control over some other things that happen around us, right? And that's but we're a special being.
Yes, get it, got it, wrote it.
Aha. So it's very important. All right, so the point is that, and that's I think I was trying to paraphrase this, right? So the essence of risk management, it's just basically we trying to maximize what we have control over, right? And those elements that we don't have control over, we then look for ways of minimizing the impact on us. And that's why we trade with a stop loss, right? In the event that the market is not, the price is not going in that direction, what do we then do? It means that as a trader, we have a loss absorbing capacity. And there's a limit to go, and we say, no, I think this, I can't accept this risk anymore. And the trade is going to hit your stop loss and you're fine, right? And that's because it is above your risk threshold. And that is fine, right? So we must understand that there are some aspect of our, of our trading life that we may not have direct control over, but there are some aspects that we can control. So just let's think about it. Let's have a discussion, right? So as we are trading, what are the areas you feel that as a trader you have control over?
The areas in which you have control is being able for me to go in and find the key levels of in the market so that we can find entries, and being able to help in terms determining what the stop losses are. The key for me, though, the issue for me is going down into my lower time frames to find the more sniper entries. Like, for instance, on yesterday, I literally I was in a trade and I was in profit, and I knew that it was going to retrace. I had my stop loss in, and I felt like it was going to hit my stop loss. So I got out of the trade, which was already in profit. I closed it, and then I went back and set an order so that it can go back for an entry that would capture the retracement. And then the trade took off in my direction, and I missed the 30 pip trade in my direction, and I was like, oh. So for me, is more, I want to be able to find those entries that give me that minimum retracement.
Are you there?
Yes, I'm there. I was like, oh, did I miss it?
Okay, no, I got your point. I thought it was network. I didn't know that you were done with your thoughts. Yeah, I think those are valid points, right? So in terms of, the things you have control over, perhaps your markup, where you take a trade, even the decision to say I want to trade today, you have control over that, right? So you can say today I'm not trading, right?
Yeah.
So those are you have control over those. Just the way you spoke about. So you can say, oh, I don't take a trade on the 4-hour time frame, daily time frame. I must go to 1 hour, 15 minutes, just so that I have a tighter stop loss. So that the market will not force that on you, correct? That is within your circle of influence, right? So there are a lot of So we can just look at those, right? And it is important that we get that understanding, that there are aspects of our trading journey, our trading activity that we can control. But there are other aspects that we don't have control over, right? Because it is dependent on our broker. So for example, I give you a quick example. I was in a GBP card trade on Friday. And so I had the trade over the weekend. And you know what? When the market opened on Sunday, I saw that my broker has stopped me out. And it was strange because I had that same trade on a different broker and it was still running. So I was wondering, how did he hit stop loss on this other one? So again, that is outside my control, right? But in that instance, what is within my control? It means that in that broker, I shouldn't hold the trade over the weekend because the kind of manipulation that will happen, I don't have control over, right? So, but I can decide to say, you know what, I'm not even holding any trade over the night or over the weekend, right? So we need to understand those bits so that we are not frustrated by the other part that we don't have control over.
Yes.
Okay, so for example, your position sizing, your lot size, you have control over it, correct?
Correct. And that's definitely
so exactly. So you have your lot size, you can control that. You can say, oh, I want to trade with a standard lot. I want to trade with a micro lot. I want to trade with a mini lot size, right? So that we have control over. So in terms of risk management, what we're interested in is to focus on those areas that we can control, those areas that we have control over. The ones that we don't have control over, what we'll then do is how do we minimize our risk? So you understand the logic now?
Yes.
So for example, the lot size, our trading decisions, right? We have control over that. We can say, oh, I want to trade, for example, I can decide to say, you know what, I'm not trading gold. It is my decision. Whether some other persons are making good money trading gold, it's immaterial to me, and that's because I've decided, correct?
Right.
So it's my decision. So it doesn't mean that I'm not a smart trader. It doesn't mean that I don't have a good strategy that I can use to trade. But it then means that I have understood myself and I know what works for me. Because we need to align our trading to our lifestyle, right? So whatever works for you is what you stick to. And in sticking to that works for you is that you must ensure that, you know, you are doing it the right way. And if you do it the right way, there's no way you'll not make money. The other part is that the decision can either be positive or negative. So I can decide to say, you know what, it is only good I'm going to trade, let's say. And I know that perhaps it's not in alignment with my temperament, right? I've entered, let's say, 10 gold trade, I've lost 9. But it's good I want to trade. I just like trading gold. So at that point, you know, the discussion would then be, is that a good decision, right? Am I just getting inclined to gold? Is it in terms of being a professional trader, is it a good thing to do? Because what we should be interested in is how do we make money, right? The other indices that will drive that profit, they are secondary, right? So if we're not making money, there's no point. We need to then go and do some review and say, you know what are the 1, 2, 3 factors responsible to my losing money in the market? I don't know if you got the point, right?
Yes.
So our decisions most times are very critical. So Somebody can decide to say, you know what, I trade only forex pairs. That is the person's choice, you know. That decision could be ridiculous to a different kind of trader, right? But you know what? That person who had said it's only forex pair that I trade, that person may be making money for himself or for herself. And it's fine, he's happy. The most important thing is that we do what gives us joy and gives us fulfillment. Some other persons can say, you know what, I only trade GJ. That is the only pair I have. If I don't see trade, I leave it. You know? Some other persons will say, you know what, I just mark all pairs and I trade once I see a markup that aligns with my trading style, regardless of the pair, I take a trade. So those are decisions that traders take. So it is within our control. We are the one to take that decision. With all the knowledge that we have, we are the one to decide, right? To say, this is how I want to go in my trading journey. This is how I want to trade. These are the pairs I want to trade, right? And just like what Joshua would say to the people of Israel, right? That regardless of what you say, but I and my household, we have decided to serve the living God, right? So it's a personal decision. Nobody takes that for us, regardless of our knowledge, regardless of our expertise. You know, that decision is personal. That is one aspect that nobody can compel the other person to do X, Y, Z. It's a personal decision. So your lot size, your trading decisions, these 2 points, they are within our control. They are within our circle of influence. So for example, our trading expectations, correct? Are we? Yes, our trading expectations are also within our circle of influence. So some other person could say, do you know what? I don't take a trade that is less than 1:3 risk reward ratio. If I'm rating 20 pips, I must make a minimum of 60 pips. That is fine. Some other persons will say that, well, what is important is my win rate, right? I look for 1:1. If I'm risking 20 pips, I want to just get out 40 pips and I'm fine. Well, that is that person's trading style. Some other persons could say, you know what? Any trade I'm taking, it has to be 1:5. If I'm risking 50 pips, I need to take 250 pips. Now, in these three personnels, their temperament will differ, right? Their shock absorbing capacity will be different. Is that true? Because the person who is doing 1:1 is going to be hitting the target if the trade goes in his favor very quickly. Is that correct?
Mm-hmm.
And that person will tell you that my win rate is high. The other person who is doing, for example, 1:3, again, there could be some emotions. The trade will go, it will retrace, but eventually it can take a day or two to hit the target. It will make good money if he's patient and is able to maintain his or her emotions, right? Then the person who is doing 1:5, if and only if that trade gets to the TP of that person, cumulatively, that person will be making a better profit, right? Because one trade will give in substantial amount of profit. But again, it means that it's able to tame his or her emotion, because the trade is going to play with his mindset. It's going to, again, you make about 50 pips, it retraces to your entry. Even goes further down as if it's going to take you out. Then it goes again and gives you 100 pips, right? So it means that the mindset will be very different. So it then means that we need to understand this part. The kind of expectation in terms of our target, it is very important that we set the right target for ourselves. So the other part, again, that we have control over, our trading strategy, right? So if you are trading, so again, I was listening to somebody, and was talking about big traders and people who are making money, they just do the simplest of things. Right? Are we there? Don't mind me. I just wanted to be sure that you're on the other side.
Yes.
So the people who make money consistently, they just do the simplest of things. You'll be amazed that some 7-figure traders, 6-figure traders with their personal money, not funded account. Some of them just trade break and retest, for example. And that's their trading style. Break and retest. They don't know anything you're talking about, change of character, break of structure, liquidity grab. Do you understand it now? So that's how they trade and they make money. So you keep it simple, stupid, right? That's the key strategy. Keep it simple and stupid. It looks stupid to the other person, but you are making money. Some other persons will just trade maybe support and resistance. That's the only thing they trade, and they are making money. They don't know what is imbalance. They don't know what is the structure. That is the style that works for them. Some other persons, again, they are smart money traders. They don't trade except liquidity has been grabbed. Again, they are making money. So, but what is important is that you must have a trading style. And for you to stick to it, you must backtest it to be sure that you are making money from it. So if you have a strategy and it's a losing strategy, it's not a strategy. You have a strategy that net position you are positive, it's a strategy. And you then look for ways of improving it. Perhaps where you then lose money, maybe the element of impatience because one is on a chart. You enter a trade when it has not properly aligned with your trading style. We have those kind of situations. All of us were guilty of this. Or perhaps maybe you enter too soon. Maybe you enter without confirmation. Not that your trading style is a problem, but at that point, we are the problem, right? Because the human emotion then takes the better of us. Impatience. So when somebody says indiscipline, looks very harsh, right? But because we're talking to ourselves, that is the reality, right? Because discipline is adherence to whatever laid down procedure that you have defined for yourself, right? It means that one is very disciplined, right? To say, until XYZ align, I'm not going to do ABC. That's discipline, right? And that element of patience then comes in to say, if it does not align this way, I'll wait for it until it does align, right? That's patience. So the point is that we don't need to complicate our life. We would seek knowledge, acquire this knowledge, but eventually we need to aggregate all this knowledge and then say, what works for me based on my attribute as a person?
I used to think that my strategy was just support and resistance and just looking at the structure. And over time, I think including all of the different things, learning all of the different things, adding that to just the key levels of support and resistance has definitely added some confusion to my strategy of US 30.
You see, so that's a point, right? So yes. I think one thing is that awareness and realization. And again, I always mention it to people that anything that is very complicated is going to fail because you'll not be able to replicate it. You yourself, you'll be confused. Even to explain what has happened, you don't have any clue, right? Because it's like somebody is like a mesh, so many things. You can't extract anything. So the strategy that works is the one that is very simple, that you know what is working. You see, this is what happened, and this is why I took the trade, right? So it's as simple as that. If one cannot check it and say, this is the reason why I took a trade, it means that one is not trading any strategy, right? One should be able to replay the alignment you saw before you decided to take a trade setup. And that is very important. Until we get to that point, we may be struggling. because we can make a lot of money. Then maybe subsequently you then lose a lot of money. You may not really know what even made you make that first money, right? That you made. So that is the kind of confusion that can set in. But if one is trading a strategy and with understanding, if you enter a trade and everything aligns and you won the trade, you know why, right? You're so happy because it's a strategy that you traded and it worked. If you also trade that strategy and the trade goes against you, two things may have happened. One is that you may have set, excessive expectation, right? Maybe where your take profit is supposed to be in, you didn't set it there. So you're staying in that trade for a long time. So it retraced and took you out. So there could be element of greed in there. It could also be that perhaps it's just one of those trades that you lose, even though there's proper alignment of your strategy before you took that trade. And that's because you don't have control over the entirety of the market, right? There are fundamentals that you don't have control over. There are some manipulations that set into the market that you can't control. And it could also be that, well, it aligned with your strategy 90%. There was a 10% that you didn't pay attention to, right? Meaning that all the boxes were not ticked before you took that trade. So those instances are there. But the most important thing is that, just the way Socrates would say, the man know thyself. So we need to know ourselves and then know the kind of strategy that we are adopting. Keep it very simple with understanding. And if we trade that way, we're not making money, we will then look at it. Let's do a refinement, right? Just the way we want to trade the stop loss is 50 pips. So let's go to a lower time frame and do a refinement. It could be 20 pips, right? So we can refine a strategy to a point that it then becomes precious like gold. All right, so let's proceed. One is, how do we manage risk, right? We understand that risk in itself is exposure to danger, right? In trading, we could say it's exposure to losses. So that's the risk. What's the risk in trading? The risk of losing money. That's the only thing. If you fund your account and you lose it, that's the risk, right? That's the risk of the trade not going in your favor. That's the risk that exists because you don't have control. And how do we mitigate this risk? So we trade with a stop loss, right? But if you also trade with a stop loss and you trade 20, you enter 20 trades, and those 20 trades hit your stop loss, eventually you lose your money, right? Even though you have traded with a stop loss. So it means that one aspect of risk management is also knowledge. So one needs to have understanding, very, very important, right? And knowledge, so that other things can then align. So let's go into it. We'll look at the possible ways of managing risk. So again, we don't want our account to be looking down. Again, the best can be in control and we'll make money, we'll sell, right? But eventually, we don't want us to be going downward in terms of our account balance, not necessarily in terms of the price action. So number one is that to manage risk, first off is our lot size selection. That's our position sizing. This is very important. And that is the leverage that we all talk about, that we don't want to over leverage, correct? Yes. Because oftentimes while we are panicking, while we put ourselves in a position of stress, is that we've entered trade with a lot size that if it goes against us, the impact is going to be severe.
Okay, so Mr. Paul, so yes, that part I get. I understand that part, but what I'm missing with that part is when you have an account that's, so for instance, if I have an account that's $10,000, an appropriate lot size for a $10,000 account and the ratio of risk managers is what should, and then and then two, you have to, what the pieces that are missing for me is they differentiate between brokers. Like for instance, I have a Osprey account. Osprey account with Osprey, with I trade US 30. Everybody knows this, so it's no secret. US 30 on Osprey, a 0.01 is $10 in the market. Well, in my funded account, a 0.01 with them is $1. So that ratio from $1 to with
$10.
with the account, right? A 0.01 is $1. With Osprey, 0.01 is $10. How do I determine what the ratio of a trade should be based off of the balances, based off of what the lot sizes are? Those are the pieces that are missing from me. So when we talk about risk management and we talk about trade management, that's the pieces that'll help me. I know what a lot size is. I understand that the lot size is going to help me with my managing of my account. But the meat and the potatoes is what is that calculation as it relates to the balances on my account, one, and then the payout from the brokers in my MetaTrader 4. That's the pieces that I need my classes to help me with. Does that make sense?
A lot of sense.
Okay.
A lot of sense. So let's go there.
Okay.
So let's look at this. So this is just, what you just said. So if you look at this table, what's typically done is the first column is saying account balance, correct? In dollars. And we're talking about the risks on your capital, right? What percentage of your capital you want to risk in absolute terms, right? So in this table, we've looked at you risking 5% of your account, correct? So 10% of $100 is $10, right? 5% is $5. 5% of $200 is $10 in terms of absolute amount, not about lot size now, right? Are you following the logic?
Yes.
That's one aspect. So the other aspect is that what is even your stop loss, right? So because your stop loss is an input, your lot size is an input, then it then translates to that quantum of your capital that you are risking in that trade, right?
Yes.
So in this example, we've used a lot size of 50 pips to say you are entering a trade, right? And the trade is 50 pips, right? Now, number one is this is your account balance. Could be $100, $200, up to $800, right? And you are risking 5%. So the first part is that you agree with yourself, with your mind, and say, I want to risk a maximum of 5%, correct? So if you want to risk a maximum of 5%, again, let's say you're not able to just say what that will be. Bring out your calculator. You say 5%, 5 over 100, right? It gives you an amount times what is your account balance. It gives you a value. So you hold that value in your hand. If the value is too high, you say, well, I don't want to risk up to this, correct? If you don't want to risk up to that, it means that your lot size will be a certain size, correct? And your lot size and your stop loss. But let's just take this so that you get the full appreciation of what this table is about. So let's say somebody has an account balance of $100. And that's a trader wants to risk 5%, right? 5%. Risking 5% of $100 is $5, right? $5. Now, and let's say that this person, the trade that this trader is entering is 50 pips stop loss. So now in this case, we're not interested in risk reward ratio. It's just about managing your risk, right? Your target is not the same material in here. Now, the fact that you are trading with, you want to risk 5% of your capital and it gives you $5. And your stop loss is 50 pips, right? It means that your lot size cannot be more than 0.02.
Okay.
Do you understand it now? So if your lot size cannot be more than 0.02, why is it 0.02? Because in dollar form, it means that it is $0.1 per pip. Correct?
0.001. You said 5% over $100.
Yes. No, 5% times 100 gives you. So, the first point is that you want to know what, in terms of your account balance, let's say you have 1,000, right? $1,000.
Okay.
And you want to risk 5% of that. That's about $500, right? Let's say that's $500 because 10% is $1,000. So $500, that's what you want to risk. Now, if you're entering a trade and is
Wait. You said I got $1,000 account and I want to risk what?
And you want to risk $10,000 account, right? And let's say
$10,000 account. Okay, that makes sense. You said I was gonna say no, that ain't matter. That math ain't adding up.
yes,
Okay,
no, it's
$10,000 account, and y'all want to risk 10% of that is $1,000. Yes.
Yes. So
Yes. Okay.
let's even say you want to risk 5%, which is $500, right?
Okay, 5%.
And you see a trade, and you trade it, let's say it's 20 pips stop loss. You know that if you trade with a standard lot, right, 20 pips, if it hits your stop loss, that is just $200 loss, right?
If it hits, it's a $200 loss.
Yes. First, the standard lot of 1. So for you to know the dollar, you multiply it by 10. That's per pip. It means that it's $10 per pip.
$10 per pip. Yes.
So it means that if somebody then trades with two lot size, 2.0, that's $20 per pip. And if the stop loss is 20 pip, that will be $400. It's still within the person's risk appetite because he had said, I want to be able to, risk $500. Correct?
Yes.
So the first point is that you want to tell yourself, what is the percentage of my account I want to be able to risk? I have the capacity, right, to risk on this trade. And once you know that, and you know your pips, so let me, the first part is that, somebody may look at this table and be struggling. You can easily get the risk on your capital, right? So this one is a decision to say, I want to risk 5%. So if you say 5%, you just do 5% times your account balance. It gives you whatever it is here, right? 5% of 800 is $40, correct? So column 1, column 2, straightforward. Column 3, straightforward, is based on your trade setup. You then know your stop loss, the size of your stop loss. Is that correct?
It's a what stop loss of 500?
No, sorry,
no,
50 pips. This is 50 pips.
Yes, 50 pips stop loss. Yes.
Yeah, so this is just a flat 50 pips across, right?
Yes.
Now, we're not saying that based on this your account balance, based on the fact that you want to lose just $5, 5% of your account, this, and your lot size is this, and your stop loss is this would be your lot size, right?
Yes.
So how will you get this? How will you get this? One is that, again, because we are experienced traders, right? You can look at it and say, oh, 0.01 pip, what it means that it is $0.1 per pip, right? No, it means that I'm using 0.01. But you know that your capital is in dollars, right?
Yes.
So what can you do? You do this capital that you want to lose, let's say for this trade, you want to lose 5%. You divide it by your stop loss. It's going to give you, if you divide 5 by 50, it's going to give you 0.1.
So I can do 5 trades at 0.0. I can do 5 trades at a 0.01, a 0.1.
No. So for example, if you have $100, right, you want to risk 5% of it, which is $5, right? So that's the part of, if $5 leaves your account, you have a balance of $95. So that will not trigger any panic mode. Maybe for you, right? It's okay, I'm going to lose $5. But this trade I'm entering, the stop loss is 50 pips, right? You would then divide that capital you want to trade off by 50. It gives you 0.1, but that is not the lot size. That tells you what is your dollar equivalent per pip, right? So it gives you 0.1. So it means that per pip movement, you are risking $0.1.
Yes.
So for you to now know the lot size, you divide it by 10. So that is the lot size you are going to key into your MT4.
Okay.
Right?
Got it.
So for example, we go to 200, 5% of 200 is $10, right? Let's say losing $10, that's about $190. I'm not scared. It doesn't take anything. Let's say that is the trader's mindset. And he's entering a trade and it's 50 pips. What is he going to do? He will say 10 divided by 50. 0 up here, 0 down here. That's 1/5. That's 0.2. 0.2, it means that per pip movement is risking 0.2 of the $10. Right?
Yes.
Now, if he wants to enter this trade, he's not going to enter with 0.2. He's going to divide it by 10 to not get the lot size, which is 0.02.
Okay.
Because you multiply your lot size by 10 to get your dollar equivalent per pip.
Okay.
So this person who has an account balance of 800 and wants to be able to reach 5%, which is $40. $40, this my account, I'm not, I can easily get it back. And it's a 50 pips, trade that person wants to enter. So it means that I can trade with 0.08. How are we going to get 0.08? To say 40 divided by 50, it gives 0.8. It means that is the dollar equivalent per pip, 0.8 per pip. And that's why when you do 0.8 times 50, which is 50 pips, it gives you $40, right? But the lot size will be 0.8 divided by 10.
Yes.
Is it understood now?
Yes.
So basically, let me run it again, because this is very important, right? This is one of the ways one will enter a trade and you can just throw your device and you're not scared. Because you've already made up your mind that it's just 5% of your account that will be impacted. Right? And let's say if you win that trade, you're going to have extra 10%. Let's say you are trading 1:3, and it eats your take profit, you are going to grow your account by 10%. Right? So the first thing is that you look at what is my account balance. So for example, if you are, again, there's a class we're going to take, right? So I will not jump into it. If you are trading a funded account, this is quite different. The way you look at it will be different, right? Are we together? If you are trading a funded account. So if you are trading a funded account, for example, the minimum stop out for a day is 5%, right? So if you are trading a $5,000 funded account, it means that the only loss that they will allow you without breaching your account is 5% of your account, which is $250, right?
Yes.
Now, when you want to do this for a $5K funded account, you not come and put 5K funded at 5,000 here and say you want to risk 5%. Of course, if you want to risk 5%, it's $250. But if it gets to 250, it means that it's a breach. You must not get to the maximum, right? So what you then do is that you assume that your account balance is $250. So you not come and put 5,000 here. You put 250. In that instance, you can say, okay, I want to risk 50% of that, which is $125, right? Because what it means is that if it hits you, it's not breach your account, right? So you say, okay, $125 is what I want to risk, and it's 50 pips. I will then do 125 divided by 50, right? And let's say it's even 20, let's say it's 20 pips stop loss that you're using. 125 divided by by 20. That would be about, let's say 12.5 divided by 2, that would be about 6.25. Now, 6.25 divided by 10, that's about 0.6, right? So it means that you can trade with the 0.6. If you trade with 0.5, for example, and it hits your stop loss, that's $100, right? 0.6 then gives you $125 or 0.7, right? So it's straightforward. So, but the baseline is that you must understand, what is my account balance? What percentage of this account balance I want to risk? Then what is the stop loss on this trade? Divide that portion of your account you want to trade off by your stop loss, and divide it by 10. It's going to give you your lot size.
Okay.
All right. So let me just quickly wash through the last slide, right? So now, so we've looked at this part, very critical. That's why it took time. How to manage risk, right? So the final part is how to dilute your risk. One is that we know that risks exist. We have looked at how do we manage it, but how do we even dilute it further, right? Which is part of risk management. So what we can do is that we can scale out our entry and exit, right? So, you know, in the previous slide, we talked about your lot size. Now, somebody who knows that he wants to lose, let's say, $40, right? And you know that your lot size is 0.08. Is that correct?
Yes. Wait, what did you say?
So I'm looking at this guy who has $800. You want to be able to risk $40, and your stop loss is, let's say, $50, right?
Mm-hmm.
Now, and you don't want to use, of course, you know that you will not use more than 0.08. Now, let's say that $50, 50 pips is when your entry is from, let's say, from an imbalance, right? And that is your 50 pips. So you say, okay, maybe at this point, I'm going to enter with 0.04, which is half of this. And maybe when it drops, it goes lower, when it gets to your entry, you entered with, let's say, half of the position. If you are in drawdown, let's say you are in drawdown of about 20 pips, you enter another position. If that trade hits your stop loss, you are going to be losing less than $40.
Because you was starting with a 50 pip stop loss?
Yes, exactly. Because your first entry was 0.04, 50 pips. Your second entry, you entered it when you were in drawdown of 20 pips, and you still entered with 0.04, which means that second entry is 30 pips.
Right.
So eventually, if it goes against you, your total loss will be less than $40. So that's what we are talking about here in terms of scaling out your entry, right? So you know that, okay, I want to lose 5% of my account. You can then look at your loss size and divide it by 2 and have 2 entries, right? Because you know that maybe I cannot be too patient to wait for it to get to this. This is the conservative entry. We'll say this one is aggressive entry, right? So your aggressive entry, let's say you have 0.08 to trade or 0.1. You can say my aggressive entry, I'm entering with 0.0040503. If it gets to my conservative entry, I'm going to enter with 0.07. So if you entered on time, when you're being dropped down, you're not being deep drawdown because your position size is small.
Right.
So that's how to also scale out your entry, even your exit, right? You may be targeting 100 pips, but you can do your first exit at 50 pips. One position has closed. You have the money in your kitty. You know, you do another position, maybe 70 pips, you are exiting it. The final position, you are exiting it, and on the final, the 100 pips. So that's how to scale out, you know, your position and your exit also, so that in the event that there's a retracement, you would have made some money. And when you are closing some trades, when it does retrace and eating part of your profit, you are not scared, because it's just like icing in the cake. Icing on the cake, rather. Right? Okay, so the final part is, of course, we need to trail our stop loss. How does this work? You enter the trade. The trade is now 40 pips in profit. Your target is 100 pips. Why not move your entry into 20 pips? Why not move it into 10 pips? And you know that you have a 30 pips that is floating in the market. If the market comes back and takes your 30 pips, worst case, you have 10 pips. I know you will not be happy, right, that you lost part of your profit, but you also be happy because you'll be net positive instead of allowing the trade to come and eat your principal.
Yes.
Right? So that's the way of also managing our risk. So it's very important, right? And one thing we need to note is that it is better to make little profits than for us to lose our capital, right?
Right.
So if you say that you want to be making $10 every day, it looks very small, right? $10 every day, it looks very small. But let's say you have 20 trading days, and let's say you're able to get 15 days to see your setup in the market, and you traded $10. That's $150. So $150 in a month, $150 in 10 months is our $1.5 thousand, right? It's huge money. So it's not about what is the daily run rate, right? It is about what is the cumulative benefit.
Right.
So it's very important, right? Because consistency is the order of the game. It's not necessarily the one-off profit that we make. So that would be, if we have questions, let's take it. If there's any aspect that is not clear, we can use additional minute to explain.
No, I think for me, I think that the key thing was the breakdown for the lot sizes and the balance of the account. I think it was the understanding. So the formula to use is simply to take the balance of your account and calculate the percentage that you want to have for each trade. Then you take the amount of pips that you want to make per trade. And then once you take that amount of pips, you then are going to take that and divide it. And then once you divide that by the lot size, you divide that by, you take 50 and you divide it by the pips. And then you divide that by 10. Right? So you take in the 5% divided by the 50, which was going to give you that 0.1.
Yes.
And then you take the 0.1 and then you divide that by the 10, and that's what gives you the lot size.
Correct.
Yeah, so that's the key for me. I look, the whole class could have just been about the formula. Once I got the formula, the meat and the potatoes.
Yes, so it's very important, right?
Yes, that's the key, because that's what's important when I go into my MT4, saying, okay, today's my balance is, and my percentage today is, or not today is, what my goal of my account is. So a successful class, Mentor Paul. I appreciate you. I got some great notes, and I put a star by this slide today because that was when it comes to risk management and the trade management, that's the part that I needed to make sure I completely understood, and I think I do. So kudos.
Fantastic, fantastic. All right, so it's a good time to end the class.
Yes, thank
Let's have
you.
a blessed night rest, and let's continue to
Yes,
practice.
yes, thank you.
Well done, Mr. Paul.
Ishe,
All right.
Ishe.
Shame job. So let me end the class now. Good night, everyone. Bye.